The U.S. debt collapse isn't a theory anymore. It is happening right now. In the middle of the largest Middle Eastern conflict in decades, the gold price is crashing, U.S. Treasury bonds are buckling, and the Federal Reserve is quietly bailing out the global economy to prevent a total economic crisis. Right now, gold just crashed 11%, breaking below $4,175 an ounce. This liquidity crisis makes zero sense, unless the US dollar and the Treasury market are fundamentally breaking. The default assumption is that geopolitical war means you buy gold to protect your wealth. Wrong. When global supply chains freeze and an economic crisis hits, sovereign countries don't need gold. They need US dollars. And the desperate, silent scramble for those dollars is about to make your mortgage, your car loan, and your overall cost of living astronomically expensive. Look at the raw data. The International Energy Agency confirms the Strait of Hormuz is effectively closed. 20% of the world's seaborne oil trade is completely blocked. Kuwait exported 0 barrels of oil in April. I am not giving geopolitical commentary. I am tracking the math of the global financial system. Since the 1970s, the world has relied on a simple agreement. Gulf nations sell their oil globally for US dollars. In exchange, they take those massive dollar profits and reinvest them into US Treasury bonds. This petrodollar recycling is what allowed the United States to run massive deficits for decades without consequence. But when the oil stops flowing, the recycling stops, and the system breaks in reverse. When nations like Kuwait and the UAE lose their oil revenue, their cash flow stops immediately. But they still have massive sovereign bills to pay. So, what does a wealthy country do when it runs out of cash? It sells its savings. And the savings account for the entire world is the US Treasury market. Japan holds over $1 trillion in US debt. The UK holds nearly $900 billion. Kuwait holds over $66 billion. Here is the shareable soundbite. When everyone sells the exact same asset at the exact same time, the price collapses. Let me break down the math simply. Imagine you hold a US government bond that pays 5%. If you suddenly need cash and are forced to sell that bond to a third party, they know you are desperate. They won't pay you full price. They will pay you 80 cents on the dollar. Because they bought it at a massive discount, their effective yield, their return on investment, just went up. Now imagine entire countries doing this at the exact same time. When the price of a US Treasury bond drops, the yield, the interest rate the US government has to pay to borrow money, skyrockets. The US government runs a multi-trillion-dollar deficit. It survives by borrowing new money every single day. If the UAE and Kuwait dump tens of billions of US Treasuries onto the open market to get cash, no one is going to buy new bonds from the US government unless the government offers massive, double-digit interest rates. And because Treasury yields dictate the entire US economy, your personal borrowing costs spike. Corporate debt refinancing freezes. The housing market completely locks up. This is exactly why the gold price is crashing. We are in a sovereign liquidity vacuum. In a panic, massive institutions sell what they can, not what they want to. Why are they liquidating gold? Because hedge funds and central banks use extreme leverage. When a crisis hits and their other assets bleed, they get a margin call demanding immediate cash. To get that cash, they sell whatever they can easily liquidate. Gold is highly liquid and was sitting at all-time highs. They sell their winners to cover their losers. They are liquidating gold to get US dollars because the oil shock is keeping inflation high, and the Federal Reserve is refusing to cut interest rates. Historically, gold is the ultimate inflation hedge. But in phase 1 of a credit collapse, cash is the only oxygen in the room. But if all these countries are dumping treasuries, why hasn't the US economy broken yet? Because the Federal Reserve is quietly bailing them out. You might be thinking, the US government wouldn't just hand billions of dollars to foreign nations during a domestic inflation crisis. They would, and they are. It is called a central bank swap line. Instead of letting the UAE sell its US treasuries on the open market, which would cause U.S. interest rates to explode, the Federal Reserve approaches them and says, "Keep your bonds. We will just lend you the newly printed U.S. dollars directly." Let me explain the exact mechanics. The Fed lends newly created dollars to a foreign central bank. That foreign bank pledges its own currency as collateral at a fixed exchange rate. When the loan matures, they pay the dollars back with interest. Critics call this a foreign bailout. It is not. It is a bailout of the U.S. Treasury market. The Fed is terrified of foreign nations selling U.S. debt. They are using swap lines to hide the panic and prevent a global dump of U.S. bonds. But the model assumes, actually, look at the historical data specifically. These swap lines are supposed to be temporary emergency measures. But since 2013, the Fed has quietly made many of them permanent. They aren't loans. They are the amend, extend, and pretend monetization of global debt. The balance never really goes down, it just gets rolled over. Are you currently holding long-term bonds or short-term T-bills? Drop it below, because your duration risk is about to dictate your entire net worth over the next 12 months. But here is the catch. Buying the dip on gold right now because you think this system will crash tomorrow is a massive mistake. Let's look at Marcus and Sarah. Marcus sees the war in the Middle East. He sees the Treasury market buckling. So he allocates 50% of his portfolio to physical gold and long-duration U.S. bonds, assuming an economic crash is imminent and interest rates will drop. Sarah looks at the liquidity vacuum. She realizes that as long as oil remains blocked in the Strait of Hormuz, inflation will stay sticky and the U.S. dollar will remain a global wrecking ball. Marcus gets crushed. Gold drops below $4,100 as institutional margin calls force massive liquidations across Wall Street. His long-term bonds lose 15% of their value because the Fed refuses to cut rates to save the Treasury. He thought he was playing defense, but he bought the wrong shield. Sarah stays in 3-month Treasury bills yielding over 5%. She holds U.S. dollar cash equivalents. She understands that in phase 1 of a sovereign debt crisis, cash is the only asset that doesn't bleed. Marcus optimized for the end of the world. Sarah optimized for the liquidity crisis. The limitation here is time. Eventually, the Fed will have to print so much money to fund these foreign swap lines that fiat currency will debase and gold will skyrocket. But if you enter too early, you get wiped out in the margin call. Here is your preservation protocol. Step 1. Cap your duration. If you hold bonds, keep the maturity strictly under 6 months. Do not lock up your capital while global yields are violently adjusting. Look closely at short-term Treasury bills or money market funds. Step 2. Build a U.S. dollar moat. In a global liquidity crisis, the dollar spikes before it dies. Hold enough cash to buy the real assets when they finally bottom out. Step 3. Ignore the gold permabulls until the Federal Reserve officially announces a pivot to quantitative easing or yield curve control. You wait for the pivot, not the panic. Become the type of investor who understands the mechanics of the machine, not just the headlines. When you understand that the U.S. Treasury market is the core engine of the global economy, you stop panicking about the news and start positioning for the math. But holding short-term T-bills is only half the strategy. If inflation accelerates because oil is permanently locked out of the West, your cash will still lose purchasing power. In the next video, I break down the exact asset allocation required to survive a stagflationary spiral. Click the video on your screen right now to learn more about financial survival. Do not leave this blind spot open.